Well, welcome back. This week we are covering Chapter 10, which is inventories and other short-term assets. In the inventories, there are three types of inventory available to the manufacturing firm. The first would be raw materials inventory. These raw materials then, as they are processed, become work in process inventory. And once they're finished, they go into the finished goods inventory and are calculated as the cost of goods sold. There are two types of inventory systems available. The first is called the periodic, where ending inventory and cost of goods sold are determined at the end of each accounting period. This method is now obsolete, and firms are beginning to adopt the perpetual inventory system, in which one keeps a continuous track of inventory as it enters and exits the various storage areas. In discussing the costing of inventory, there are a number of interesting points, not just inventories and goods that are available, but we have three categories that are kind of significant. The first are goods in transit. When one company ships to another, the question is who owns the inventory while it's moving. We have two designations for this. The first is called FOB shipping point, and the second is called FOB destination. FOB means freight is on board. So when we say shipping point, that means that the transfer takes place at the shipping point. In other words, the buyer takes ownership of the goods. If it's FOB destination, that means that while the goods are in transit, they are the property of the seller, and once they are received by the buyer, they become the buyer's property. Freight transportation costs are generally incorporated into the cost of inventory directly, but they can be kept separately as an expense account as well. Purchase discounts are reductions in the price of merchandise for early payment. Early payment is desirable because the firm can use the cash to generate additional income while they have it, and sometimes that can be a substantial amount of money. There are two ways of accounting for purchase discounts. The first is the gross method, in which the company records the inventory accounts payable at their full price, and then if there are any discounts issued, those are recorded separately as contra accounts. The net method, the company assumes that all of its clients will take the discount, and then simply enters the net amount of sale minus the discount. If the discount is not taken, the company later backs that into its accounts, recording that as basically an increase in the value of the inventory. There is a need for inventory cost flow assumptions because the physical movement of inventory and the inventory cost tracking do not run parallel very often. And so we have four different types of assumptions that we're allowed to make, each of these with its own consequences. The specific identification method, in which the company identifies each item in inventory individually. This is done when the items are large and costly and discrete. There is the moving average, in which the company determines an average cost for units on hand and applies that average cost to each sale to determine the cost of goods sold. There is also the first in, first out method, commonly referred to as FIFO. In this, the company assigns the most recent inventory costs to ending inventory, and the oldest cost to the cost of goods sold. In other words, we're selling the older product. And finally, we have an unusual one called LIFO, last in, first out, in which the company assigns the oldest inventory costs to its ending inventory, thus reducing the value of that inventory, and the most recent cost to the cost of goods sold, thus increasing the cost of goods sold and reducing income and therefore income taxes. Accounting for these items is therefore an interesting choice to make. It is a judgment call for the firm Once the firm has adopted one of these four methods, the IRS insists that they stick with that one method. We do have a couple of other ideas regarding the LIFO. There are 6 steps in the dollar value LIFO accounting. Dollar value of LIFO: determine ending inventory, stated terms of base year prices, determine the increase or decrease in quantity at base year prices, determine the increase or decrease in quantity at current year prices, and add all those layers together to find the dollar value LIFO ending inventory. Calculate the LIFO reserve and record the journal entry made to the LIFO adjustment. This refers, of course, to adjustments under the last in, first out assumption. When a firm discovers that its inventory is not worth what it had originally paid, we are required in the U.S. system to adopt the lower of the two costs, whether it be the actual cost or the value, the market value of the product. Determining the market value is not always easy, but it is the way in which one either measures or estimates the loss in value. Once a loss has been recognized and the inventory has been, quote, written down, that is, decreased in value, if subsequently that inventory recovers in value, or part or all of that lost value, nevertheless, in the U.S. system, we do not recapture that loss, that recovered value, through revaluing. We continue to carry the inventory at the lower value, which obtained originally. Calculating cost of sold using the retail method is also explained in this chapter. We won't go into that in this little discussion. And the gross profit method of estimating inventory is the other for inventory estimation. Detailed required disclosures for inventory that should be included in the financial reports footnotes include the following: accounting policies, including the inventory costing method and measurement bias, carrying amounts by type, inventory financing arrangements, carrying amounts of inventory carried at an amount less than the cost, and the amount of the write-down that was recognized as an expense. And finally, in the use of the LIFO costing method, when applicable, include the LIFO reserve and compute the reversal effects of any LIFO liquidations. That brings us to the end of the chapter. It is highly technical but fairly simple in outline. We're looking at different protocols to follow when recognizing costs of goods sold and inventory as we physically move the goods into those categories. How do we recognize that with accounting entries? We'll look forward to the next chapter coming up very shortly. Thank you very much.